Let's talk money.
Welcome back. This week we are discussing how you can take advantage of global equities, international equities, via the Indian mutual fund route. And as we've discussed, lots of options. There are actively managed funds, there are passive funds, but we need to understand the technicalities of that investment now. One thing that we must keep in mind is the best part is that we have to invest in Indian rupees. We don't have to take the pain of the whole, exchange rate, whether it's China, US, or any other market that you're investing in. But then there is tax, Niranjan, and we need to understand how taxation is arrived at, because there's capital gains, there could be dividends that companies are giving, or any other formats of taxes. There's TCS otherwise when you're remitting money overseas.
Right.
So I don't know, just explain all the tax layers to us.
Right. So broadly, you have two routes to invest outside India today. One is LRS route, one is mutual fund route. Let's talk about mutual fund route. It's very simple. You invest in an FOF or an ETF. Any capital gains after 2 years is taxed at 12.5%. Anything before that is short-term capital gain as per your tax slab. Dividends, whichever you get from these funds, are taxed as per your tax slab, like any other mutual fund. That's very, very simple. Now, these funds investing in maybe US funds and all, they may attract some withholding tax depending on which jurisdiction they invest, but you don't need to worry about, because everything is built in the NAV.
Okay.
On the other hand, if you're investing via LRS, there are two taxation that you need to be aware. Three, in fact. One is, while you are investing, there is a TCS, which is tax collected at source. There is a 20% TCS if you are investing about 10 lakh in any, whether it is US or China.
That is through the direct. If you're directly going to buy stocks, send your money overseas through LRS, then you need to pay this TCS.
This tax. When you invest, and if these companies pay you dividend, there is a withholding tax. If you're investing in US, the withholding tax as per the DTA is 25%. So you need to pay 25%. If you're investing in Chinese stocks, that tax rate is around 10%. So that is second layer of tax. Third layer of tax is capital gain, which is equally, which is similar to what you pay in MF. After 2 years, 12.5%. Before 2 years, short-term capital gain as per your slab rate.
Okay, this is a little complicated. Let me try and recap. So let's start first with capital gains. Capital gains is what's become favorable for international funds now. So if you're holding on your investment for 2 years, then you have to pay long-term capital gains at 12.5%. And short-term would be less than 2 years at your slab rate, right?
Yes.
TCS, we don't have to bother. If you're going through the mutual fund route, then tax collected as source is not a worry. What happens to the dividends if $100 is coming as dividends from a US company? Then what is this? In the fund, I'm just bothered about the dividend that I'm getting, along with my return.
So basically, if the fund is investing in a stock or maybe a fund which is paying dividend, then at the fund level, right, there is a withholding tax which the fund pays, or it's deducted at source, and you don't need to worry as an investor.
Okay.
Now, dividend, if the fund which you are investing in, if that pays a dividend, it is equally like, an equity fund in India paying you dividend, it is taxed at slab rate.
Okay.
So you don't need to worry about the underlying paying dividend, you need to pay tax on it. It's not like that. So in fund of fund or a mutual fund route, it is very, very simple. Better to go for a growth option, and in a fund of fund structure, the only thing you need to worry is stay invested for more than 2 years and pay that 12.5%, nothing else.
Now, if I'm invested for at least 3 to 5 years in a global fund, what should be the return expectation? For Indian equities, everybody says that 12 to 15% steady state returns, good returns. What about these international funds?
So for US, if you see, I think so, because the way market has been structured in US, it's completely different. It is no more linked to the nominal growth like we calculate in India, because US tech stocks are, just buzzing. They are giving extraordinary returns, which may continue, because even today, the earnings growth expectation over the next 10 years or so is above 15-20%. Looking at that, I think so anything between 10 to 15% is a reasonable return to expect. Over and above, you should add maybe 2-3% return from currency depreciation.
Oh, yes, yes.
So whatever return US market gives you, we saw that example 12.75, but last 10 years in INR, it's 16%. So I think so same expectation you can take over the next 5 to 10 years. But be mindful, because tech stocks specifically are highly valued. There can be bouts of volatility. The drawdowns could be higher. Better way is to, as Nasser mentioned, go in a staggered way, start an SIP. Even if you're investing lump sum, invest now, start an additional SIP so that even when markets fall, you buy in more.
Okay, got that point. Nasser, coming down to final thoughts then, you've already given us some ideas, I mean, the kind of funds that you like, but recap it all for us, the do's and the don'ts and the mistakes to avoid when you're taking this 10 to 15% exposure to global funds in the portfolio.
The question between active and passive, that is something that remains, as one of the main reasons for construction of the overseas portfolio. But clearly, I think, first and foremost, please do not chase returns because of momentum. There are enough changes happening dynamically as we speak. US-China was never thought of that they will come in with a trade agreement so soon, but we see it happening. It's obviously going to ease tension between both US and China. A few weeks ago, we were market neutral. We continue to be market neutral, but US started to look interesting. So don't chase themes basis news flow. You have to be more pragmatic. Look at medium to long term generation of wealth. Number one. Number two, I think very, very important is the end objective, your expectation on returns. I think on international returns, the global fund returns, an investment opportunity vis-a-vis expectation has to be staggered. It can't be lump sum. Please do not look at any money which is lump sum going into any of these funds, because a lot of this changing dynamically, and we feel that a lump sum approach, staggered approach, and again, currency hedge. I think please make sure, cognizant of the fact that your underlying investments are going into a different currency. Are you adequately hedged or not from an overall portfolio perspective? I think some of these are very, very important. Last but not the least, I think we need to look at whether the funds that you're investing in are those currently open or not, because there are enough regulations in place today which have been brought in by RBI, and in terms of freezing some of those investments, there's partial relief, and what may or may not be open today. So those are again something which need to be very, very clearly looked into when you're looking at the international funds broadly. And I think the last but not the least is, please don't expect superior risk-adjusted returns very quickly. I remember this old saying that it is not the time, but the timing. It's not the timing, but the time spent in these markets. And the same holds true also of international funds and international markets. So I think broadly we focus on some of these, and of course not to forget your taxation impact, which we discussed right now. I think those are again something which need to be factored in when you're looking at international funds between active and passive.
Okay. All right. Good points there. Thanks for that, Niranjan. Any final tip, word of advice, word of caution to investors as they're getting set on this global journey?
Be measured in your approach. Look for long term, because end of the day, these are also equity funds that you are taking exposure. Don't try to be over smart with the market, because it will, hit back.
If it doesn't work in India, chances are it won't work internationally.
Absolutely. The risks are same. There is no easy way to make money. Be very methodical, and your approach should be staggered way.
Okay. All right, gentlemen, thank you so much. Niranjan as well as Nasser, thank you for joining in and giving us a nice sort of bird's eye view on the whole, piece of international funds. Plenty of choices. And now, as you know, a lot of the funds are opened up in India. At least partially they're open. So you have some choices. You can go out, do your homework, and then decide if you want to invest or not. Thank you very much for joining in. It's a wrap on this edition of Let's Talk Money. We'll see you again with another theme next week.
Let's Talk Money